Welcome back to our discussion on investing in exchange-traded funds, or ETFs. For those of you just joining us, ETFs are a basket of funds with a focus on a particular sector, like gold or emerging markets. They are traded on the open market, much like regular stocks. Let's now meet our 3 ETF providers and investors. Each company will now have a chance to explain why their ETF strategy could be the next biggest winner. Howard Atkinson, CEO of Horizons ETFs, Michael Cook, Head of Distribution for PowerShares Canada, and John Hood, President of JC Hood Investment Counsel. Welcome, gentlemen.
Thank you. Great to be here.
So, Howard, let's start with you. Tell us a little bit about Horizons Exchange-Traded Funds and how it's different from other Canadian ETF providers.
Well, Andrew, we are the largest provider of ETFs in Canada with 80 funds and almost 100 listings. Wow. We pride ourselves on innovation. Okay. That comes in the form of low cost, tax efficiency, or access to investment strategies that just aren't available elsewhere. And our ETFs cover equities, commodities, currencies, and fixed income.
And your firm offers the lowest cost ETFs in Canada, correct?
That's correct.
And how are you able to offer an ETF with just a 7 basis point management fee?
So the ticker symbol for that is HXT, and it gives Canadians access to large cap Canadian equities on a total return basis. So we use something called a total return swap, which allows investors to enjoy the returns, both price and dividend returns of the index, but at a very low cost, which includes low tracking error, which means that you get the index returns minus the cost of the fund, and it has tax efficiency built in as well.
And your firm has the largest suite of actively managed ETFs in the world. So what are actively managed ETFs, and what benefits do they offer versus passively managed ETFs?
Currently we have 18 in our stable, a little over $1 billion.
Okay.
And it combines the best of ETFs, low cost, transparency, and intraday liquidity on the exchange, with an actively managed strategy. So there's some asset classes where active management can actually outperform indexing. A lot of that happens to occur in the fixed income area. So we have a very popular fund that gives investors exposure to corporate bonds, another one to floating rate bonds, another one to preferred shares, and we have a whole suite of covered call ETFs that have been quite popular with investors.
Can you tell us about some of the unique income strategies that you offer at Horizons ETFs?
It's a covered call ETF strategy, and in essence, you own a basket of securities, so they could be Canadian equities, they could be US, it could be international, and then our portfolio manager, Eden Rahim, who has 2 decades of writing calls on equities, has an active call writing strategy. And what that means is that you're selling calls in the marketplace, and that provides income to the investor. And generally speaking, our income has been on an annualized basis in about the mid-teens, so very attractive to investors in this low income world.
Michael, on to you. So Invesco PowerShares describes itself as leading the intelligent ETF revolution, correct?
That's right.
And how does intelligent indexing work?
Well, the vast majority today of exchange-traded funds are linked to more traditional indexes that you and I would use as a proxy for how a particular market or asset class is performing. Okay. And they form the basis for about 80% of the world's exchange-traded funds today. But there's a growing body of evidence and research that would suggest that although they're useful proxies for how a market's doing, they're not necessarily good investments. And our view is that whether we're talking about equities, fixed income, even currency and commodity markets, there may be a way to craft a more intelligent index structure that addresses what we feel are some of the structural flaws in traditional index construction, while still affording the investor the low cost, the transparency, the liquidity, the tax efficiency that they expect from an exchange-traded product.
Does intelligent indexing work across different asset classes?
It does, and every instance is unique because there are challenges that would confront a passive equity market investor versus a fixed income market investor. And then in further afield, if you look at commodity markets, there are challenges in traditional index construction. So intelligent indexing has broad application, and it depends on the market. And in question, sometimes it's the criteria through which we weight a company in an index that can be problematic. In other instances, it is the liquidity, say of a bond that requires improvement. And then in commodity markets where the structure can be a little bit more complex, if you're not managing the investment process in a prudent fashion, it can create challenges for you as an investor. So it's unique to the asset class or market in question, but we feel that intelligent indexing has application across just about any asset class.
What factors should investors be looking at when they're analyzing ETFs?
Well, you should look at how, in the case of an equity index, how is the index constructed? If it's market capitalization weighted, it's simply assigning the largest weight to arguably the most overvalued constituent in that index, which is not necessarily a good investment. So you want to look, first of all, at the index methodology, what's under the hood. And I think the good thing for Canadian investors is that there's more and more choice now as to what methodologies are applied in terms of the index construction. Related to that, of course, cost. We talked a little bit about that already. How much does it cost me to invest? And what are the hidden costs? You have a management fee as a more visible cost of investment, but you also have other factors like the liquidity cost.
Right.
So is the underlying index a readily investable basket? And sometimes it's not. Sometimes the constituent securities can be a little bit less liquid, so the cost to acquire or dispose of those securities can penalize the investor with additional fees that are not always transparent to them. So those are among the considerations. What's under the hood? What's the methodology? How much does it cost? And is it a liquid way to invest?
On to you, John. So unlike our other two guests, you are not here today to promote your ETF company. You're rather here as an independent investor who also manages other investments in this area.
Exactly, and I'm basically the end user of ETF products, both for my clients and myself. My strategy really is to use a traditional asset allocation methodology where I'm roughly 60% in equities and 40% in fixed income. And that I find is really the best defense against volatility in the market, is to have an asset allocation that you stick with, you adjust it based upon the volatility. So you're not caught in the headlights when you get volatile markets.
So let me ask you this. Do you currently hold a position in any of our guests'
Yes,
ETFs?
I do, certainly, and some of Horizon Beta Pro, and primarily HFR, which is a floating rate bond, HXT, which is the low-cost one, and not that many others, simply because a lot of their products are the inverse and leveraged, and that's terrific for day trading, but it's not what I happen to do. Okay. It's nothing wrong with the product. They're great products. It's just that it's not in my basket of stuff. They do have a number of very interesting covered call products that I look at. They have a couple of actively managed products, HAC, which is a seasonality technical-based one that I like as well. In terms of power shares, they're really just coming on stream in Canada right now, so I'm going to sit back and wait and talk to Mike later.
What led you to specialize in ETFs?
I went to ETFs because it was very obvious that if people were buying mutual funds, they were paying far too much. Canadian fund fees are the highest in the industrialized world. We score very badly in that regard. And those fees can corrode roughly 50% of your returns over 20 years based on normal market returns, which is an awful lot of corrosion because you're paying 2.5% to 3% a year. So I came in looking to ETFs as a way of getting around that because their fees are so low. And secondly, I wanted to introduce normal portfolio managers' fee structures, which is 0.8 to 1%, to the sort of mid-range client, the client that comes in with $300,000 to $700,000 a year, $1 million.
Okay, and I'm curious, who is your average client, and also why should they be dealing with you rather than these larger management firms?
There really isn't an average client. They come from, they're professionals, they're engineers, they're tradespeople, whatever. They basically have, between the husbands and wives RSP, roughly $300,000 to $500,000 plus a joint account. So our medium-sized account is probably around $600,000 or $700,000, but we start them off at $250,000. In terms of my firm, what's unique about it is that every portfolio is customized to the client. So nothing is pooled. Everything is designed around that particular client. And we're providing them portfolio management services, which for many managers starts at $1 million to $2 million, and they won't talk to you otherwise. So I'm bringing in the mid-market.
Right. Well, thank you, John. Thank you, gentlemen. We need to take a break right now, but when we return, our ETF expert, Yves Rodete, will make sure that their stories all add up. And stay tuned to find out whose companies he thinks are worth your money.